Now that you understand how banks make money from deposits, the next big concept is this: how do banks measure profitability from lending and deposits? The answer is something called net interest margin, also known as NIM. Net interest margin is one of the most important profitability metrics in banking. It measures the difference between the interest a bank earns on loans and investments and the interest it pays on deposits and borrowed funds. In simple terms, net interest margin shows how efficiently a bank turns deposits into profit. Here's an easy example. A bank pays customers 0.5% interest on savings accounts. Then the bank issues loans at 6% auto loans, 7% personal loans, 5% mortgages, and 18% credit cards. The spread between what the bank earns and what it pays is where much of the profit comes from. The wider the spread, the stronger the potential profitability. This is why low-cost deposits are so valuable. If a bank can keep funding costs low while earning higher loan yields, its net interest margin improves. Strong NIM usually means stronger earnings, healthier profitability, better financial performance, and more lending flexibility. But net interest margin is always changing. Interest rates have a major impact. When rates rise, banks may earn more on loans, but they may also have to pay customers more interest to keep deposits. If deposit costs rise too fast, profit margins can shrink. This is called margin compression. Banks constantly manage this balance between deposit costs, loan pricing, competition, and profitability. Credit unions also track net interest margin closely. Even though credit unions are nonprofit cooperatives, they still need strong margins to cover operations, support lending, build reserves, and provide competitive member services. Another important factor is asset mix. Different loans generate different yields. For example, credit cards often produce higher interest income, mortgages usually produce lower yields, and commercial loans may carry different risk and return profiles. Financial institutions strategically manage loan portfolios to balance profitability, risk, liquidity, and growth. At the end of the day, net interest margin is one of the clearest indicators of a bank's financial health. It tells the story of how effectively a financial institution uses deposits to generate income. And in banking, managing that spread is everything.
Disclaimer. This content is for educational purposes only and is not legal, compliance, or financial advice. Please consult a qualified professional before making any financial decisions.